So here's the thing, the market has definitely lost a lot from the highs of the day. It's 17,211. It's just unable to hold on to its highs, and that's what you can see. About 100 points gone from the top. 17,136 is where we are at currently. So just about holding on to a 90-point gain right now. It is getting very volatile. But after the collapse of Silicon Valley Bank, we have been trying to break it down on what the India exposure could be. We've reached out to several companies to find out whether, they've got hit or not, what the exposure is to SVB. Today, we speak with InfoEdge to understand if they or any of their investee companies have deposits with SVB. And a broader question is what this could mean for the overall startup economy. We still don't have a total figure on what the Indian startup exposure is to SVB and what the ramifications would be. Sanjeev Bikhchandani, who's the founder and executive vice chairman at InfoEdge, joins us now to talk about that. Hopefully, we'll get some clarity on what's happening with the startup world. Sanjeev, thanks a lot for joining in. First, for InfoEdge particularly, do you or any of your investee companies have any deposits that are stuck with SVB at the moment? If yes, what is the amount and what's the way forward according to you?
So none of our balance sheet investee companies or our subsidiaries have any exposure to Silicon Valley Bank. Okay. InfoEdge does not have any exposure. In any case, the FDIC has said all the deposits are guaranteed and they will all get the money. It is possible in our VC fund, a few did have, some may still have some exposure, but if all deposits are guaranteed, there should not be a problem. Now, the thing is that this was obviously asset liability mismatch where the bank management was wrong-footed, a few wrong calls. They were wrong-footed by the interest rate increases. They were wrong-footed by the balance sheet contraction, and they were wrong-footed, therefore, by the fact that they had invested in long-term bonds and there were short-term withdrawals. When startups began to withdraw money because they were burning and they were unable to get external capital, they obviously withdrew from the bank, and that caused a problem. This was, I would say, a near miss. The FDIC has done well to guarantee the deposits because this will limit the panic and contagion as far as other small banks are concerned.
Yeah. Okay. Just to follow up,
Sanjeev, I think the disaster has been averted.
Sure. The disaster has been averted for now. Just to follow up to what you said. So you said that none of your investee companies have an exposure, but do you know what the ballpark number would be of the startup ecosystem?
So none of our investee companies from the balance sheet have any exposure to the best of our knowledge. A few of our companies in the venture fund may have had exposure, but they are all okay now. My reckoning was that if you include startups domiciled in India that are VC funded, if you include startups that are domiciled outside India but are from India and have raised VC funding, if you include startups which have got branches and subsidiaries overseas, if you include all of that, maybe 15% of Indian VC funded startups would have had some exposure to Silicon Valley Bank. 1.5.
Okay. All right.
It's a rough estimate. We haven't done a census. We don't know, but it's my rough estimate.
15% of VC funded startups out of India may have some exposure to SVB.
Yeah, but typically most startups will have 2 or 3 banks, so we don't know exactly how much is in which bank and how much money they have.
We don't know the amounts.
So, yeah.
Sanjeev, beyond what you said that the direct level of exposure is low, are there any second level, third order impacts for the general risk aversion to the internet space, to the venture capital space?
So my submission is what it was earlier as well. That look, flipping a startup, domiciling overseas, you take on a few more unknowns. You don't know the American environment, you don't know the American banking system, you don't know the American legal system, as well as you know the Indian system. So you're taking on risks that you don't know, and in this case, some risk panned out, which you had not anticipated.
Mr. Bikhchandani, a larger question, while you quantified, I mean, roughly speaking, the exposure might be 15%. And I think this is not just to SVB, this is overall US banks, right? You're saying the exposure could be about 15%. What does this do to the overall funding environment? We've had Indian banks quickly rush out to put out press releases and really cajole the industry to come back home with Indian lenders. But what happens? I mean, the funding winter, for instance, cost Info Edge because you had to take a pretty big write-down in the third quarter on one of your investee companies. So does it start a domino chain? Does it get worse before it gets better?
Well, I think it's patchy. It's a mixed bag. There will be some companies which will be under stress. There will be write-offs and write-downs. There could be forced mergers. There could be distressed mergers. But those companies that have got good unit economics and can pivot to good unit economics and have got a serious value prop for the customers, they're selling at a price that's higher than the cost, and they have enough runway. They would actually strengthen. So
but do you see this happening? But do you see this happening in the Info Edge universe as well? Are you anticipating any more write-downs or perhaps, book out of some of these companies or any consolidation within the set of companies that you've invested in?
So we evaluate stuff on a regular basis. Okay, thus far there is no announcement to make. But like I said, it's a portfolio, it's a spectrum. Let's wait and watch and see what happens.
So I just want to confirm, you said that 15% of the VC companies, of the companies in your venture fund have exposure, right? Is that correct?
No, not our portfolio. I said in the
overall
universe.
Okay.
That 15% of VC-funded companies will have some deposits, or would have had some deposits, they may have withdrawn it now, in Silicon Valley Bank. Okay.
Got it.
Now,
for your own companies, you said some of your companies in the venture fund have exposure, right?
No. None of our balance sheet investments have any exposure, to the best of my knowledge. We've asked them. There may be a few which may have had exposure in the VC fund portfolio, but I guess they're all safe now, so it's okay.
But what would that amount be, ballpark?
I would not be able to, disclose that at the moment.
Okay. Do you have any exposure to crypto companies? Because last time you had said that you would avoid fads like crypto, metaverse, etc. We've seen a huge collapse over there as well. So any exposure that you have there?
I don't think we have any exposure to any crypto company, to the best of my knowledge.
All right.
We have about 80 companies. I don't think any of them are crypto companies.
Okay. Would you have to take any more, just, a follow-up to what you were mentioning earlier. Do you think there would be a chance that you'd have to take some more write-offs, perhaps not, if not in FY23, in FY24? Just asking because of, how challenging the environment is currently.
No, I won't be able to say that currently. But look, thus far at least, nobody's in serious trouble to the best of our knowledge. But look, this is an evolving situation.
Okay, all right. It is. Sanjeev, thank you very much for your time. Pleasure speaking with you, and good luck. Thank you for speaking to CNBC-TV this morning.
Thank you so much.
Thank you. All right. Well, 120 points higher, so after hitting the level, basically the market's reversed exactly from the same level that it reversed yesterday, which is 17,220, got to within a few points of it, and then sold off. So 17,164, this is still a pretty good outcome so far, but let's hope there is more to go here in terms of gains and recovery, basically, recovery and repair. Now, Motilal Oswal note indicates that the upcoming dedicated freight corridors are expected to change the modal mix of freight movement in favor of railways from roadways, and factors such as higher costs of fuel, expensive insurance may give a boost to rail freight in a pretty big way. The DFC, of course, has been debated for years, but now it's coming to fruition. Let's discuss the trends and how managements and companies see this impacting their business. Vineet Agarwal is Managing Director at Transport Corporation of India, and we have Vikram Suryavanshi, Vice President Equity at Phillip Capital, joining in. Gentlemen, great to have both of you here. Thank you very much for your time. Vineet, if I can start by asking you to just first up respond to what I prefaced this conversation with, which is that Motilal note and how they see the DFC impact being a big fillip to the rail sector. Your thoughts?
It's good to be back here again. Thanks for having me. I think this is a really important step in the country's evolution today. We all know that the railways only moves about 25% of freight in the country, whereas the road moves between 60 and 65%. So clearly, this is not right for the country. If the country has to be more competitive, whether it is domestically or for exports, we need to change this mix. We need to get the logistics cost down. And any shift that happens either from road to rail or from road to sea or to inland waterways, all the other modes of transport is definitely going to reduce the cost of transport in the country. Simultaneously, I think the other factor that's starting to play around why cargo needs to move from road to the other modes is the GHG, is the emissions factor. Clearly, companies looking at ESG have to start looking at how to reduce the carbon emissions. And clearly, when you're moving from road to the other modes, that does reduce it as well. So clearly, I think the trends are very obvious, and I think the industry has to start adopting to it, as well as companies have to start using different modes of transport.
Okay. Good morning, Vineet, and thanks for joining in. In fact, Vikram Suryavanshi, who is the analyst at Phillip Capital, is also here with us. And, you know, he wrote a report way back in September of 2022, which talked about the impact that the national logistics policy would have in terms of, improving last mile connectivity, reducing logistics costs, etc. Vineet, I wanted your thoughts on that. There are still a lot of issues that need to be resolved with respect to whether it's logistics capacity, last mile connectivity, ground level infrastructure. What do you think are the top 2 or 3 things that the government needs to do now in order to improve and resolve those challenges, just to improve, sort of last mile connectivity in the logistics space?
There are 2-3 factors which are important for this connectivity to be seamless, because you cannot just absolutely move everything to rail. There is always a first mile and a last mile, which means that there is a road element also involved in some way. So there has to be a seamless transition between different modes of transport. So one is clearly the physical infrastructure, which is the hard infrastructure, the infrastructure that is getting created under the PM Gati Shakti program. That multimodal infrastructure, which will be the connecting infrastructure. So there could be ICDs, there could be multimodal logistics parks, there could be road networks that are linking the railway networks or the seaports more effectively to the overall country. Those will be the hard infrastructure. The second is the soft infrastructure, which is essentially what we call the connectivity from a digital perspective. And the government has already started work on ULIP, which is the Unified Logistics Integrated Platform, where all the stakeholders involved, whether it is a road service provider, a rail service provider, any other digital service providers, customs, all of these will come onto a single platform. So there is work started both on the hard infrastructure and the soft infrastructure, and clearly this is evolving in the next few years. So I'm very confident that this will help. These points will definitely help in the shift.
Okay. Vikram, let me bring you into the conversation as well. The railways are getting extremely aggressive. I mean, we're seeing that in the volumes right now, container volumes, the data, and obviously they have extremely big plans. I mean, the kind of ordering that's going on in the years to come. So is this threat real? The threat to road freight from rail freight? And if yes, then will the listed universe companies see any pressure on just business growth?
Thank you and good morning. So if you look at the container side or rail side, in fact, container things, as Vineet said, in fact, situation is really worse. In fact, we are seeing less than 10% of cargo goes by railways for container. And most of the railway network is used for the passenger movement, and we have very limited space available for the cargo movement. And the kind of infrastructure improvement we are seeing in railways happening will definitely bring back some cargo on the railway. But we do not see as a threat to the road. A road has its own advantage in terms of complete end-to-end transportation, and the unit economics for smaller cargo is different. But I think there is a lot of cargo particularly on container side, will move back to the railways post the Western DFCC is there. Already we are seeing some benefit for Mundra and Pipavav Port. So that structural change can remain for much longer time, and probably the kind of container penetration which is between road and rail probably can shift to the rail side with this DFCC. But clearly, I think both the routes have their advantage, so we do not see as a competition to the road side, and road side will also continues to grow.
Got that point. So just if you could translate that into your view on the stocks. which are the biggest beneficiaries, or which will be the biggest beneficiaries, you think, in terms of just overall increase in freight, whether it happens on railways or on roads? Which stocks are you most bullish on?
Yeah, surely. So if you look at the container play, we are having a container corporation, when is the largest player, who controls almost like 60-65% market share. Then we have Gateway Distripass, and even TCI Limited has a joint venture with Concor for rail movement. So these are the stocks which will see the advantage of container trains basically. And along with that rail, we are also pretty sure that the kind of growth we'll see in container is going to be very secular, because if you look at overall penetration in India is very less. We are talking about hardly 20 million TEU container volume, which is expected to go almost like 40 million TEU by 2030. And I think container is one of the global way of moving cargo, which I think will start following up in India, so with the infrastructure picking up. So I think there is these are the companies which will benefit from this secular growth rate in container logistics and rail movement.
Vineet, freight is about 50% of your business, right? And the majority within that is part truckload. How is that business doing? I think you had indicated some softness in FY24. I mean, with lots of elections, etc., being a factor as well. Can you update what's happening?
So on the company front, I think things are quite okay. I think FY24 seems to be okay so far. There could be a little bit softening towards the end of the year, but I think it seems to be still okay. And the LTL sundry business is also growing quite rapidly. So I think that is a positive sign. Broadly, I think I just want to take Vikram's point forward also. I think the fact that there is so less containerization in India, and that's the third pillar of the national logistics policy, which is multimodal logistics, digitization of logistics, and thirdly, standardization of logistics. So you see all different types of trucks in the market, and essentially it's because the cargo is not standardized. It's not put into containers. And once that starts happening, we will see a bigger flip to not just the road transportation business being more organized, but also, and in turn, a business like ours getting positively impacted, but also that shift will happen from road to rail.
Since you're giving us some numbers, you said there could be some softness in demand in the near future, but for FY25, you had a revenue target of 2,000 crores and 20% margins. Would you stick to that despite the near-term challenges that you may face?
I think you're talking about specifically about the freight business in our thing. So yes, that we will stick to that those targets.
Okay. All right. We will leave it at that. Thanks a lot for joining in and giving us an update on the freight business and the overall, industry as well. Vikram, thanks to you too. Well, let's get back to the market now. We have the market that's come off quite a bit. So Mitesh Thakkar is joining in to give us a quick call on the index. Mitesh, the market has lost a little bit of steam from the top. So that high we hit was somewhere around 17,211, come off quite a bit now. Your thoughts and any individual stocks that you'd look at?
I think, Prashant was highlighting 17,224. I was looking at 17,280. I think very difficult for the index to get past those levels. So yeah, I think around those levels, you could possibly explore some shorting, again, beyond 17,200 levels. But on the stock side, I think, we're still trading with some positive bias. Couple of stocks have given very good reversals, could do well. IEX is one of the stocks which I've identified today. That's a buy. It's just trying to get past the 200 average. So that's a buy with the stop below 148 half levels for targets of around 160 on the upside. And L&T is something which is breaking out of a contracting kind of a setup. So that's a buy with the stop at 2170 for targets of 2250.
Okay. All right. Mitesh, thanks very much for that. Appreciate you joining in with that. Well, we'll take a quick break here. Up next, Manisha joins in with a quick check on what's happening on commodities. Oil sold off 4% overnight. There was a big one. So we'll put the spotlight on that and more. Stay with us.
Welcome back. Well, Adani stocks continue to be in focus after a morning context report published on Monday, the 13th of March, reported that Ambuja Cements and ACC are owned not by the Adani Group, but by Vinod Adani-controlled entities. CNBC-TV18 has gone over the disclosure made in the open offer document for Ambuja Cement and verified that the open offer was made by an entity controlled by Vinod Adani. The disclosure reads, and I quote, "The ultimate beneficial ownership of the acquirer, Endeavour Trade and Investment Limited, Mauritius, is held by Mr. Vinod Shantilal Adani and Mrs. Ranjanben Vinod Adani." The chart on your screen indicates the multi-tiered SPV ownership structure.
All right.
Okay, so Adani Group spokesperson tells CNBC-TV18 that Endeavour Trade and Investment Limited, controlled by Mr. Vinod Adani, the acquirer of ACC Limited and Ambuja Cements Limited, belongs to Adani Group. This fact has been disclosed in our public offer document dated the 19th of August 2022. The point of concern on this is that the Adani Group had indicated in its response to Hindenburg's allegations that transactions with Vinod Adani entities did not qualify as related party transactions as per Indian laws. Adani Group's response on non-disclosure of related party transactions with Vinod Adani Group entities said, and I quote, "All transactions entered into by us with entities who qualify as related parties under Indian laws and accounting standards have been duly disclosed by us. Further, these have been carried out on arm's length terms in accordance with applicable laws. Vinod Adani does not hold any managerial position in any Adani listed entities or their subsidiaries and has no role in their day-to-day affairs." End of quote.
Okay, that's the Adani Group response. But let's move on now and focus on the commodity markets. Oil prices have actually bounced back. So there was a fall up to $78 a barrel. Now there's a tad bit of recovery. But Manisha Gupta is here to tell us what she's focusing on this morning. Manisha, over to you.
Well, thank you for that, Sonia. I understand that it's going to be about the sell-off that we've seen in equities and commodities and the recession fears and, of course, the March interest rate monetary policy meeting from US Fed. That is all in focus. But an even bigger headline on the backdrop really seems to be coming in from the weather part of it. And we are looking at further reports, especially two of them in last 24 hours, which have come in from international agencies, now putting focus back yet on El Nino. Well, the chances of El Nino have continued to rise. We have seen reports almost on a daily basis here. Now, what is El Nino? It creates abnormal warming of the Pacific Ocean. We also do understand that when you talk about that, it is known to negatively impact the Indian monsoon, and the forecast is likely to see more clarity or more focus, or you'll see more accuracy coming in only by the earlier summer months. So by April or May is when we'll understand on how strong the El Nino is and what months really could get impacted by that. Well, when you look at the Indian markets, what we have seen in the El Nino years, that we usually see data shows this, that 60% of a probability of drought comes here, and then there is nearly 30% probability of below normal rains, and there is only 10% probability of a normal rain in El Nino years. Now, when you look at these El Nino years as well, we have seen these linked to a poor southwest monsoon, and the earlier El Nino years have been 2009, 2014, 2015, and 2018 as well. The last 3 or 4 years in the Indian markets have been good monsoon, above normal monsoon, but this year, international agencies predict that there's a 50% chance in second half of this year to see an El Nino. We've seen those kind of moves come in from the Australia Bureau of Meteorology. They have said that. It also is Japan Meteorology Organization which has said that. The Bureau of Meteorology Organization also has said a similar thing. And then you also have the US National Ocean and Atmospheric Administration, which also has said that there needs to be caution, and you could be looking at weather disturbances coming in starting as early as July or August. And they are all advocating caution, as we understand there. India, when you look at that, the month of Feb 2023 was the hottest, warmest in 122 years. And the SkyMet already has warned in the Indian markets of an El Nino. We are yet to see an official statement come in from IMD on that. IMD has said that they will come with an official statement only by the month of April. Now, when you look at the global markets as well, the global average temperature can raise by 0.2 degrees Celsius in an year of El Nino. And when you look at the overall temperatures in any case, 1.08 to 1.32 degrees Celsius is what we've seen temperatures rise since the pre-industrial levels.
Okay, thanks for that. Well, the market is slowly and steadily giving up its gains. So the Nifty bank is off its highs, the markets are off their highs. stocks are slipping into the red. So
Sonia,
the fun was short-lived.
We need that green, so you stay on. I'll take a break. we'll come back after a quick break. Well, 90 points higher on the Nifty. Well, on the other side, our special segment, it's the economy. Lata will connect with Mithul Kotecha of TD Securities and B. Prasanna of ICICI Bank to discuss the collapse of SVB.